welcome to the 50 to 1 million pound challenge tutorial videos. Now, some of you may be familiar with my Twitter account, and on my Twitter account I've been trading from £50, and the idea is to get to £1 million on such a small account. Why? Because just to be able to trade from £50 to 1 million needs considerable skill. And the reason I do it is simply to prove to myself that I can confidently trade in all conditions. And I think that if you start with the right way of doing things, you'll be able to trade with £50, trading with £5,000, £50,000, £500,000 is easy. Now, I'm not asking you to trade £50, I'm not encouraging that because that's very dangerous. But just by showing you these tutorials, you can trade with 200, 500, 1,000, and the idea is to show you how I achieve that, to show you how it does work, and to hopefully give you more confidence in your trading and perhaps teach you something along the way. And of course, all my trades are verifiable, so you can check my FX book at any time. You can see what mistakes I've made and what profits I've made too. So, a little bit about me. In 1996, I started the music degree, and I moved into teaching in 1999. Now, why do I say that? Because I think music and learning a musical instrument to a professional level, which I did, the practice and the discipline for a delayed reward is very similar, I think, to trading in some ways, that you've got to learn from your mistakes. And it's really a psychological game that we're playing here with trading. It's not so much about techniques. We can teach you techniques. Now, I first began trading back in 2006 when living in Boston, USA. I used to trade the US stock market. I was reading lots of books at the time all about the stock markets, and I opened my first E-Trade account. A good book was How to Make Money in Stocks with the Can Slim system, which was William O'Neill. Great stuff. And also Intelligent Investor by Benjamin Graham, and of course watching Jim Cramer on television with Mad Money. In 2007 I moved to Singapore and I traded on the Singapore Stock Exchange. During my time in Singapore I signed up for various trading courses, and amongst them I met Brent Penfold, who wrote the very good book on Universal Principles of Successful Trading, a book highly recommended. I also met Daryl Guppy, and I still use Guppy's multiple moving average, which GMMA, which very much recommend you get familiar with, and I'll tell you a little bit about it during the course of this tutorial video. I also did have experience of losing thousands of pounds by taking part in an auto trading service. I won't say who by, but I was wiped out of 70% of my account was destroyed by somebody who is quite well known as a 2 times World Cup trophy winner. So it's not all roses out there. Returning to England in 2011, I studied with Larry Williams for his commodities course through the Larry Williams University. Again, a great training course. I spent many months studying that material, and very useful. And in 2016, I was amongst the first cohort to join ICT in his mentorship. Very good stuff again. People often ask me, what is the mentorship, how is it? And yeah, he's very good. ICT seems to can trade himself. I'm not quite sure of how easy it is to replicate his trades, but learnt a lot from him. Then following that, I moved on to Anton Kreil's Pro Forex course. Again, very good training, particularly very much so in fundamental training and really analysing what's going on with the markets. And then further to that, I took the Global Macro Pro Trader course through the Fortis Trading Academy. Again, very good training there as well. Then I joined the Apari Fund to become eventually becoming a gold level 2 funded trader. Now I think for me the Apari Fund was the turning point in my trading. There's so many different ways you have to trade. You have to be a scalper, you have to learn to trade in very tight perimeters, and it was really that turned my trading around to actually then becoming a profitable trader, and something that I'd highly recommend if you're interested in that. but just beware the leverage is quite restricted, and there are some disadvantages with that, but I found it very useful. And then by January 2018 I was achieving an average of 12 to 15% each month, and that's all been documented. Some of it's still on my Twitter feed if you want to see that. That's absolutely fine. And yeah, from there I just went from strength to strength, and reached a goal of 1% a day, and since then I've been maintaining that 1% a day. It's not always 1%, sometimes it's 2, sometimes 3% in a day. Then other days it could be I don't get very much at all, or even make a small loss, but overall I could say I'm quite a consistent trader. Trade with great money management, and that's something that we'd like to get on with now, and teach you something about that. Now, what can 1% do for you? If you were to trade 1% a day, so maybe sometimes a little bit more, sometimes a little bit less. If we said average of 35% in a month, let's say, for 3 years, what would that do to £50? Compounded every month for 3 years, you'd be looking at the end of the 3 years of over 2 million. So I think it could be safe to say we could get 1 million in about 2 to 3 years. Of course, the curve is not going to be straight upwards, but with good money management, this is absolutely achievable if we are consistent with what we're doing. And this is what the purpose of this tutorial video is for. Trading strategy. Now, this tutorial is not about how to trade, how to do the basic trades. It's really about how we create 1% a day. So if you're looking for the basic information, there are plenty of tutorials online for you to follow, and I'd advise you do that first really before coming to learn this strategy. But in a nutshell, my strategy is very simple to follow. It is the accumulation of many years of experience, practice and fine-tuning. And I go back to the idea of practicing an instrument again. There are no shortcuts to practicing an instrument. Many hours are needed, lots of blood, sweat and tears. The same is true of trading. You can't expect just to suddenly turn up and expect that, oh, I can do 1% a day. It's going to take a lot of time, a lot of training and a lot of patience. Ensuring we've got that, so there's two main fundamental things I think that we need to make sure we've got in our trading strategy. The first one is the fundamental analysis. We need to have absolutely full confidence, I believe, in understanding the trade that you take. You never need to take a trade that you don't understand fully. Now, there's an endless amount of information you can learn before taking a trade, and it takes a bit of time to get used to this and to be quick at it, but you really need to know what's going on in the background of every trade. So how do we do this? We look at bond yields, which reflect the interest rates. Bond yields are leading indicators. We need to look at global macro, what's going on in the global macro political system of the country as well that we're trading. Very important. ISM reports can also help, and one of the most useful reports for me is the CO2, the COT, the Commitment of Traders report, which comes out every Tuesday, which really tells you what the banks are doing with the money, and that is absolutely paramount. Very much so. And I also use a historical book here. I've got in front of me historical forex data on seasonals, published by the Moore Research Centre. I happen to use a 2016 edition, which is fine for what I do, but also by looking at that. So what we're really looking out for is a confluence of different places to find all this information out, but which all adds up to give you a picture of something that's definitely going to move at some time. Now, what we never know, and I'll keep saying this, what we never know is when things are going to move. And for that, we do look at news announcements. We do look ahead on the calendar to see what's coming up today and what's coming up in the future of the week and what could possibly move the market, but we never really fully know when it's going to be manipulated, and I have some very good examples of that quite recently that I'll go on to today if we've got time. So fundamental analysis is extremely important. The next thing to look at is the trade management. We really need to understand with the fundamental analysis how volatile the pair is. Is it correlated, and is it behaving in the correct way? And what does the price action dictate? And this is what ICT is great at, I think. Price action, what does it tell you about things? Also the money management. Money management, this is why I say to trade with a small amount first. Once you've got a small amount sorted out, you're not going to mess up a big account. Believe me, I've blown up thousands of pounds in the past because of my money management, just going all in there thinking, oh, this is looking great, this is looking great, this is looking great, and all of a sudden it only just takes a freak money manipulation and you're out of that trade, and you can lose hundreds. So every take is a risk, but we need to ensure that we're taking the smallest risk possible for the maximum reward at all times. So trading management, absolutely paramount. With my strategy, I can trade the strategy with a full-time job. I don't worry about it. I can set up trades in advance, and that is how I trade sometimes. Other times I'm trading all day long, of course. I trade all currency markets, and at any time I'm scanning 30 currency pairs at one time to find the right trade, the right fitting trade that I'm looking for. Now, talking about currency pairs, it's really important that you understand what you're trading. I don't think it's a secret that the Euro USD attracts the biggest trading volume in the forex market. Therefore, it's the biggest pair with the lowest spreads available. It's heavily impacted by news events, and most of its movement is made during the London session, but typically it does not make much movement during a day. So therefore, if you're looking to scalp with a small account, you need to have big volatility movements, and Euro USD is not going to give you that. So the big trap, really, the market makers, or the people that make up the markets, is that they encourage people to trade this pair because it's just got a small spread. It's cheap for people to trade it, but you're very unlikely to make much money. So the tendency is to over leverage in order to make up for this, and that can be a death trap for money management. The British pound v USD commonly spikes up and down. It is well known for its volatility and big movements. It's mostly traded during the London sessions, and price does like to challenge support and resistance quite a lot of it. So a lot of spikes up and down. We get a lot of false breakouts with this pair, so that's something to be really wary of. Trading days, it does react quite heavily to news events that go on, and also at the start of reversals this is very choppy, often corrective, and sometimes quite slow as well, so be careful of that one too. The US dollar yen is another pair which is heavily impacted by particularly news events, the dollar news events, and when the USD is in consolidation it can really slow down tremendously, and the range often is really small. But when the US dollar is in a major trend, it usually continues in that trend with no major or large pullbacks, often pushing and pushing. So it has a different characteristic than both of the other pairs, and typically the retracement levels are a lot less in the Fibonacci on the US dollar Japan than you would ever find on the British pound, and certainly different to the Euro USD too. Here is a chart. What are the characteristics would you think this is, if you have a think about it? Hopefully you can see there's quite a lot of spikes on this chart. It's taken it completely at random. It is the British pound versus US dollar. And hopefully you can also see the spiking behaviour, especially when it comes to reversals in this currency pair. So what I'm trying to draw your attention to here is not to go for all the currency pairs, because that would take me forever, and you're probably getting bored of that already, but it's to say that each currency pair has a completely different behaviour, and there's certain ones you never want to trade with a small account. I personally trade a good 30 currency pairs. Ones to avoid particularly would be the British pound versus yen, which is also known as the beast. The reason being it's whipsaws, and you'll find that it uses what 1 pip would be in the Euro USD, twice the amount of movement in the British pound versus yen, so it will quickly destroy your account if you use that. Another one to really avoid is some of the exotics, particularly the Turkish lira with the US dollar. That's extremely volatile, and you'll soon find yourself depleted if you go in the wrong direction of those. But like I say, it's all due to your study. You've got to do this work yourself really to really understand the currencies, but you should be aware of this. You should be aware of the characteristics of the traps of trading each different currency pair. There are also many different correlations between currencies that are also very, very important. Some of you may know that the US dollar yen works in inverse often to the price of gold. And I'm sure many of you understand the relationship of the Aussie dollar and the gold, and also the Canadian dollar with oil. So of course, by following the price of oil and the fundamentals of what oil is doing, you are also looking at those particular areas of the world economy too. Okay, so let's get into a trade, and I'll show you a trade that just at this very moment, which is the 3rd of January, is actually working for me, and I'll show you how I went about to trade this. Bear in mind, I won't have time to show you every single thing here, but I'll give you an overall view of how I go about it anyway. Now, the first thing to consider that we've got the New Zealand dollar versus the Japanese yen. And first of all, we have to know what's going on with the banks underneath to make sure that our trade's going to be viable for a start. So if we look at the New Zealand, that's the first of the pair. We've got history going back roughly about a month or so there, and goes back to the 29th of October, as you can see there, and you can see what the banks have been doing. The longs have been variable around about 14,000 or so. The shorts have been roughly about 40,000 to 50,000, and of course you've got the totals there now. Now what you can see though quite clearly is this percentage of shorts to longs. There's only 27% longs, mostly shorts, and that's been variable, so it doesn't really give us a massive indication, but it is saying that the banks on the whole are going to take it down to the short side. Now of course, to be absolutely thorough, we'd now go and have a look and see what the commercials are saying regarding the Japanese yen, and whether they've been increasing their longs or they've been increasing their shorts. And of course, what we're looking for is that the Japanese yen is going to be increasing its longs. That's what we do. I won't go through that now, simply for the length of the video, and because this is just really an overall view of how I do my trading, so you can really see for yourselves. But I'd encourage you very much to go into that. Now, where do you get this data from? You get the data from cftc.gov market reports, commitments of traders, and you can find all the information that's published every Tuesday online. I'd encourage you to do that and to put that into an Excel spreadsheet so that you've got record of it and you can see the historical background and whether they're increasing their longs or increasing their shorts, of course, whether they're buying or whether they're selling. Now, having got the fundamentals looked at a little bit, and there's plenty more ways we can do that as well. I'm just touching on that subject today. is to look at the next thing, which I look at the GMMA, which is the Darrell Guppy, which we referred to earlier, the Darrell Guppy multiple moving average indicator. And what it basically is just simply some faster moving averages and some slower moving averages. And we can see that when we impose these averages on, it gives us a pattern on here, and you can see here very, very, very clearly in a trend there from 17th of October going upwards. And as you can see, as it's moving up, the gap is widening between the two bands there, so it's getting wider and wider in the middle there between the two bands. And as they're coming apart, well, the tendency is that they'll want to come back again. So it's like a spring, like pulling open the spring, and it's got to shoot back again. So as we're approaching December, you can see at the top there, not only is the markets going up and up and up and up and up and up and up, and remember what the CO2 is telling us is that the banks are actually going shorter and having lots of shorts, more shorts. It was 73% or so were short, and the rest were long. So obviously this is not quite right, is it? Something's wrong here. So as it's coming up to the top there, it's going right to the top of the band indicators there, which really shows us it's overbought. Now we can also check that in a device called, indicator, which is the stochastics, which is used quite a lot in stock trading. I wouldn't rely on the stochastics very much really, but they do show there that it's actually starting to show it's an overbought sign for this currency. So being overbought, it's most likely then to fall. So we've got a few things here. We've got the commitment of traders is telling us one thing. We've got the Darrell Guppy multiple moving averages telling us that it's really getting to the top of its overbought range, and also we've also got the stochastics that are now starting to fall. So that's at least three confluences. Now we can find more than this. We can look at price action. We can see that if it keeps rising like this, there's going to be less and less and less liquidity as we're going higher and higher up. And what we should really be looking at is also the weekly charts, the monthly charts, to see if there's any reference points to where it's actually taking out liquidity from an earlier stage, an earlier trade in the year. Now, as hopefully you can see now, we're on a weekly chart. You might notice that my chart looks a little bit different. It's green and black as opposed to the other colours I had in the other one. I used many different templates. This one just gives me a little bit more clarity for seeing what's really going on. Now hopefully you can see that back in July there, I think it's about the 7th of July, you can see there was the wick there where it pumped up there, and notice we've just exceeded that wick. We've come November, so we've just hit above that wick, so we've taken the liquidity from that trade. So now we are ready. The banks have got their money from the people that have been waiting since July with a stop loss on that. That's going to be the funds, and they've taken that liquidity away, so now they're ready. There's some catalyst there to give us a reason for this trade to now look at reversing and going down further now. So again, this gives us another idea, another confluence idea, that the trade is most likely to fall now. We've got the commitment of traders telling us this, we've got the stochastics telling us this, we've also got the Darrell Guppy multiple moving averages telling us this, everything's telling us this. So are we certain that this trade is going to fall down? Well, not 100%, but we're getting closer and closer with each little task we look at. The next thing to look at will really be to be checking that other pairs such as the Aussie dollar are doing this similar type of things, because that's a country that's very close to New Zealand, and also the other Japanese pairs, what are they doing? So that's why I trade from 6 monitors. I'll show you an example of it. This is one of my monitors, and I have 6 charts on the same monitor here. This can be done with some software which I can recommend to you very much. If you're using MT4, I'd go for floating charts. Very, very good for doing this, but there's also other ways you can do it, which I can teach you about if you're interested. Now we've got the European yen, we've got the Swiss yen, and we've got the CAD yen on the top, and at the bottom we have the British pound yen, the New Zealand yen, and the Aussie yen. And what these clearly show, each of these 6 charts clearly show, mid-December we've got a turning point. We've got a situation where the yen is getting stronger, so it's made an obvious change in December. We've got a situation where all of the currencies have reached a point. I say all of the currencies, majority of the currencies have reached a point, perhaps not the British pound yen, where they're turning. So that gives us confirmation that something is happening. It's not just a freak in one currency, it is definitely going on across all the currencies. Perhaps the CAD yen also is also not showing perhaps the same amount of turnaround there. So seeing of these, how do we know which of these pairs to trade? Well, you could in fact actually trade all of them to a certain degree. I mean, certainly a Euro Japan would be a good trade to take. The Swiss yen, you'd make money from that. You can see it's got a long way to fall there. Of course, you'd want to check the weekly charts. I'd say the CAD yen looks very good as well. The pound yen I wouldn't go for, because as I say, we're expecting probably with that build up, as you can probably see around about the 141 mark, that build up just before the peak there shows there's been a lot of market action around that price. There's a lot of support going on there, so I wouldn't go short on that. I'd certainly might be looking for long on that. The New Zealand, as you can see, it's reached a high point there. It's been going up and up and up and up for many days. Each one of those candles is a day long, so everything goes up in a straight line. Eventually it's going to get tired out, and as you can see around the 73 it's making that turn there, and it's broken the market structure, and that's why we decided to get into that trade and the trend as well. And of course we could also look at the Aussie yen as well. That's also a great trade. It's gone past all its points, perhaps hasn't had such a great run up as the New Zealand yen, hence I prefer the New Zealand yen, because it's been going up for a certain, well, it's been stretching itself more, the amount of days in that. So hopefully you can see what I mean by that. But to say the angle on the Aussie yen isn't perhaps as steep as the New Zealand yen, so we want to be looking out for steep angles as well. Swiss yen is showing that, so that's a good trade also, because the faster it goes up, the more likely it's going to be like a rocket. It's going to come down again, and you just have to know exactly where the points are. So hopefully that helps you somewhat with that. I have just noticed, don't point this out to me, but you can see there perhaps it's saying W1 on the indicators, but it is actually the daily. You can see it's the daily charts there, and it says daily below. Just in case you wanted to point that out to me, I do notice that there's obviously a problem with my charts there. Going back now to the New Zealand yen, we now established it's probably going to be a short, so we have to think about our price entry points, and also we want to make sure that we're in a trade that's ready to move. How do we ensure that? Well, like I said before, on the weekly chart we've obviously got the liquidity taken out, and we can now look at a smaller time frame, going down to the daily and the 4 hourly, which is a very good chart, and it all really depends on the time frame of your trade. Many of my trades will go on for about 4 or 5 days. That's the preferred time I like to trade for, but it can be that sometimes 2 weeks it can take. It depends on your patience level really, but for most trades I'll probably be looking at the 1 hour, the 4 hour chart, and also the 15-minute chart. I think the 15-minute chart is probably the most useful of all of the charts in some ways, but let's have a quick look at what's happened here in the 1 hour chart. Now as what has been pointed out by other people, this is not my thing, but there's a thing known as big numbers. When you get to a certain number, there's often causes a magnet. So as we see as 73.5, half, 73.5, 73.555, roughly around that area, 750 would have been a big number there. So often it gets drawn to those big numbers and it will react against those big numbers, and you can see it's obviously taken that liquidity out. So the safest thing is to not get in the first lift. You'd never do that. And the second lift, you notice, is not quite as high as that, so you're starting to begin to see that it's actually starting to fail a bit there. The third high, hopefully you can see these three highs. I can't really draw on this chart without going through quite a long process actually. I must get that sorted from the next video, but as you can see, as it hits about the 73.345 level, it's then starting to peter off, and you can notice it's getting lower lows, and also there's lower highs as well coming down to this, so it's starting to fall off. Now what you're looking out for is quite a big drop, and we don't really get that until let's just look down here. We've got about January, just before January the 2nd there, we've got that big dip of 3 days of real pull down there. Now you can see that's obvious evidence that the banks are doing that. It's pulling it down somewhere. And where does it bounce? It bounces around the 72.820 level. You can see, hopefully that's where I've put my sell, because you can see it's found the support from earlier on. There's an area there. I'll just try and just show you that. 1 second. Well, apologies for my crude drawing. I'm not used to this making videos, but as you can see here, I put the area of the consolidation I was just talking about, and you can see it goes back to the area of consolidation, which is completely expected, because that's where they're all buying. That's where it's manipulations happening, and as you can see, it comes back to that area of consolidation and takes a jump up. And if I was using a stop loss, that's where the black line would be. Above that black line would be where I'd actually think about taking a loss on that, because I wouldn't expect it to be going up there. Now, as you can kind of see, by putting that line across there where the sell trade was, you can see it kind of gives a kind of a top. It's like a top of a mountain or so. And one thing I learned off Larry Williams is that often the mirror image would happen, so your target could actually be I'll have to draw that one time. Right. Oh well, that didn't go too well, but you can kind of hopefully see that. What I mean is that you can, perhaps that should be a bit lower, but you can get a target there for where it should be. The Fibonacci is a much better way of doing it, Fibonacci indicator. And of course now I can put my stop somewhere where that target would have been. I can move it down there, so I've got a trade that's always going to be profitable, and then just leave it to run as long as it's going to run. As far as targets are concerned, you're looking for a place of liquidity. But bearing in mind that this has been going up for so many days, many days, and it's really reached its peak, it's probably quite likely this is just going to carry on for quite a long time. So we've got plenty of time to find our target. Now I hope you can see now that it's really important, and I'd like to talk to you about setup really, that getting your workstation set up in the correct manner is extremely important. You're going to have absolutely no chance trading on a phone. Trading on a laptop is very difficult. Believe me, did it for many years. Those are the years I weren't very profitable at all. So really strongly recommend you getting sorted out with a trading station. Not to do so rather, would be equivalent to trading blind really, because you can't see, and you're against some of the toughest, most intelligent people on the planet trading this, and the market makers, they don't make it easy for you. So how do we go about this? Now I trade on a PC format. I'm sure it will work on a Mac either way, whichever way you prefer. I just find PCs, easy to use. I don't particularly like using Macs. I use MT4 as the platform. I think MT4 is just something that's been around for such a long time. I'm so used to it that I prefer to use MT4 because it's got all the indicators that I need, and I'm very, very used to that. You can go for CTrader if you really wanted to, or any other ways of trading, but I just find that MT4 is supported well, and it's just does the job for me. No need to go for the fancy platforms and subscription services to data. That's not needed, in my opinion. So, if you're going to treat this as a business, what else do you need? Well, I'll go for Floating Charts. It's a software program which will enable you to detach your charts, so you can actually have 6 or even 8 charts, or even more than that, all tiled onto one screen. You can of course go for these great big monitors where you could get 30 odd charts on the screen if you wanted to. That's completely up to you, but Floating Charts, I would say, is a great piece of software. You can also do it in other ways, but I definitely go for Floating Charts. And it's really, really important that you check out that your graphics card will support monitors if you're going to buy more than one monitor. I've gone for 6 monitors. I got them reconditioned off eBay for about £20 each monitor, so I think I bought them as a bulk for less than £100 or so. So you know, do look around, get the good bargains out. There's plenty of good bargains to be had. You've got to have yourself a decent computer, one that's not going to crash, and a good internet connection too. Now, once you, as I said, you've got all of this sorted out, what you need to look at then is how to set all your charts up so they're all correlated. And for this, I'll show you how I do my charts. It might seem a bit strange at first, but I'll explain as I go about it. Setting up your charts, the keys to the kingdom. Now, setting up charts really is the key to the kingdom. If you can see what's happening in the markets, you've got full vision, you can see exactly what's happened. If you can only trade from a phone, like I said before, you're as blind as a bat. Now, with 6 monitors, you can use more than 6. You can use less than 6. I prefer to use 6 because it just gives me a really, really broad view. On the first monitor, it might be a bit peculiar because I actually only just use 2 pairs. I use the USD yen, and I'll have that in 4 different time frames, and below that I'll have gold. Like I said to you, those two are correlated, so you want to see how gold's moving, because often we get the situation where if the US yen is increasing in value, then we've often got a decrease in gold, and vice versa, so they operate against each other. So you can see that correlation, and when that breaks, it can help you with your trading. Now, it really depends on how the markets are going, to what time frames you want to use. If I was going to be scalping, I'd be going for low time frames, using 1 minute, 5 minute, 15 minute charts, and maybe the 1 hour chart. If I'm not scalping and I'm looking for more long-term trades, then I'm going to use more like the daily, the 4 hourly, maybe the hourly chart, and maybe entry on the 15-minute charts. In addition, I'll often have my trade boxes open. You can probably see this, the first 2 charts there. We've got the sell and the buy. I often have those at the ready, set at the size that I'm going to be trading, because if something happens quickly, I don't want to be fumbling around looking for the right buttons. Just simply press the button, then you're in straight away, and you can be out straight away. So that's another helpful thing to do, to have them enabled on the charts that you're thinking of trading. And of course, that'll be sorted out at looking at your fundamentals first, looking at the longer time frames, so you know exactly what you're going to be trading. You're not just going to be pressing buttons willy-nilly, making sure that the trades that are only active are the trades, that the ones that you are definitely thinking of trading that day. Below the gold and the US yen, below that on the bottom left hand side, that monitor there, I'd have 6 charts on there, and we've looked at this before. I'd have the yen pairs. So in the top left hand corner with the euro yen, central with the Swiss yen, and followed by the CAD yen. Then below the euro yen would be the British pound yen. Very important that those two are together. Then below the Swiss yen we'd have the New Zealand yen, and then below the CAD yen we'd have the Aussie yen. Again, having the New Zealand and the Aussie together is also very important because you can see the correlation between the two, and being geographically closely located, they often moved in a similar way. Now we come to the two center monitors. The top of the center monitors has, on the top line, it has the euros, and the bottom, you notice, will have the British pound. So if we want to compare, we look at the top left hand chart would be the euro CAD, and then underneath that we can compare that with the British CAD. The second chart along, we have the euro New Zealand dollar, and below that we have the British pound against the New Zealand dollar. Again, so we can correlate the two. Once you know what's happening to the euro and the British pound, you can also gauge the behaviour of these charts. Next one along is the euro Australian dollar, and below that we have the British Australian dollar, so you can see how these are closely related. Again, right next to the New Zealand dollar as well, hence they are located where they are in the world as well. And also the following one, we've got euro British pound, and beneath that we've got the British pound against the Swissy. So hopefully you can see the correlations that are going on here, how important it is to have them right next to them. One thing what you might notice is that a lot of my templates are a bit different every time you see them. It's just simply the way I trade. I like to draw up different templates at different times, and that's just how they were sitting when I did the screen grab there. But yeah, we'll move on now to the center bottom chart, which again will have 4 charts on it. So it's 4 charts in the middle. Actually, that's not quite right, is it? There's only 7 charts here, but you see what I mean. So the bottom central chart is probably the most important. That's why we have them straight in front of us, so we can see all of this when we're trading during the day. So on the top line then, we've got the euro against the US dollar, and then straight beneath that we've got the British pound US dollar, 2 very important pairs, I'm sure you agree. The next we've got US Swissy, and then underneath that we have the New Zealand against the US dollar. Then we have the US CAD, and then underneath that the Aussie dollar, and you can see the Aussie dollar and the Australian dollar again close to each other. Then in the right hand top corner we have the dollar index. Of course, we never trade the dollar index, we just use that to see a little bit of insight into what's happening to the dollar. And I usually have a space there which can be used for a variety of things. Sometimes it's just to put an extra chart there if I need it for one of the exotics perhaps that I just want to quickly look at, or I want to have something maybe a different time frame and put 2 charts next to each other down there. So it's very movable, all of this is, but you can get the gist of why I'm doing this hopefully, and you can hopefully begin to see now that where I put the charts is not just willy-nilly, it's carefully thought out, it's conducive to good trading. Let's move on to the right hand top corner. So now we look at the top right hand monitor, and you'll see there's 6 different charts on this. Again, pay no attention to the time frames and everything, what's going on with charts. It's a bit of a mess, but you get the general gist of what's going on. So we've got on the top line, we've got the Australian dollar, and we have the Australian dollar versus the New Zealand dollar. We have the Australian dollar versus the Canadian dollar. and we have the Australian dollar versus the Swiss franc. On the bottom there we've got the Canadian dollar versus the Swiss franc, the New Zealand dollar with the CAD dollar, and finally the New Zealand dollar with the Swissy. Now if you are going to trade more of the Aussie pairs than New Zealand, if you're perhaps looking at trading in that time zone, then this area is very, very useful to you. I mean, it is useful during your trading day no matter what, but it does tend to be a little bit less looked at, hence it's in the right top corner, so perhaps we're not going to cast our eye so much as we would do to the trading down the middle of the charts, down the middle of the screens in the center zone. But very useful, and you can see hopefully how that is all correlated, perhaps, and hopefully you're getting the idea there why we're doing this. Okay. Now the last monitor we're going to look at, but certainly not the least monitor we're going to look at, is in the bottom right hand corner, and here we've got 7 charts. Now again, I use a gap there for various things that I may want to look at, the US dollar versus the Singaporean dollar, for example, or something like that. So to have the extra space there, and sometimes you could even have messaging going on there if you've got Skype up. So as it goes across from the top, we've got Brent oil versus the US dollar, which is very, very handy, especially when you're trading the Canadian dollar as well. Then following on from that, we've got the US dollar versus the NOK, and the NOK of course is the Norwegian kroner. That's a great pair to trade, really good. It can move quite a lot, so you've got to be a bit careful when you've got small accounts. I wouldn't trade on a £50 account, but once you get into the few hundreds, you're pretty safe with that one. It's great currency to trade. And then we've got the US dollar and the Mexican peso, which is another fantastic trade, but you do have to be careful if you're holding it for a few days, because the interest on the trade there, the carry trade, well, depending on which side you're on it, can certainly be more than you're getting on your trade, so be careful with that one. Then in the corner there I've got the US 500, which is the S&P 500 really. It's the stock market, so it's great to see how that's responding to things. And outside of the scope of this video, we could discuss how the stock market influences the currency markets, but as I say, that's not for today. Now on the bottom line we've got the US dollar as the SEK, which is the Swedish currency there, and then we've got the South African rand, which is the ZAR sign. That's the next one along the bottom there. And finally we have the Turkish lira against the USD, so that's USDTRY. Now a word about that. It can really move, that really can move, and once I was in the trade, put quite a lot on it, and it moved very, very quickly, and it can really, really hurt you if you're on the wrong side of that. So I say be extremely careful of that, and I wouldn't be trading that with anything less than at least a $500 account or £500 account, and then I'll be using a size of 0.01. Now I'm very aware I haven't spoken about position sizing, and when I say 0.01, different currencies require different amounts, and it's all part of money management. So money management is just so important, like I've said. But my philosophy is that you've got to learn to trade small first, because you need to get a feel for the markets first of all. Too many people go in there with big lot sizes, and you can get hurt. But it's psychological as well. So if you're going in there with 0.00, it doesn't really matter if the trade goes against you. It doesn't really matter if you lose a trade. There's not much reward in that, but at the same time it's really training you not to get emotional with your trading. There's nothing worse than being in a difficult trade, a trade that goes against you when you've got a big sum of money on it. You really need to have the smallest amount and then just grade up from that. So it's much better, I find, psychologically, to have a small account, do lots of small trades. And the way to progress is to have many small trades that work over time, and your account will naturally grow. If you're only trading 2 or 3 trades a week, they've got to be big trades. If you're trading 10 times a day, or often I change 20 trades in a day quite frequently, it's the average of those 20 trades that's going to create the profits for you. Now, of course, some trades look a bit more favourable than others, and you can certainly risk more. The more likely it is to work, or the less risk you've actually got in it, and that all depends on your entry point, where you're going to get into the trade and where you're going to get out of a trade. Now, the final thing I'd like to talk about and have a bit of fun is to talk about this butterfly that's on your screen now. Many people ask me, what are these blue lines? What are these blue shapes on your charts? How do they affect my trading? Do I use them? Well, I'll show you how these work. So this is known as a harmonic scanner. So what this does, and you can get harmonic scanners from many places. Harmonic scanner just scans the markets and then just alerts you to when one of these harmonic patterns occur. Now, you can look into harmonic patterns, what they all are. There's various different things. There's bats, there's butterflies, all kinds of different shapes. But they're basically worked out on a Fibonacci series, I believe. I don't know all the ins and outs of them, but what I do know is that they often work, not all the time, maybe about 50-60% of the time. They seem to be quite reliable, and as you can see from this one, if we're looking at the Mexican peso here with the US dollar, we can see on the 1 hour chart, had we followed this signal there, we get the bottom of a butterfly given to us on the 30th of December. We've got in the bottom of there, there was a lovely progression right up to the top there, and it tells us where to get out, and then we go short, and we can confirm that because it's taken the liquidity above the highs of December the 27th, roughly around there, and you'd also obviously check on other things, but also notice the stochastics is beginning to fall there. So at that point, you could probably safely go in there short, and then wait for the next signal, and we get that roughly about the 3rd of January. There we get another signal to go long again, and again that should be confirmed by price action. It should also be confirmed with the stochastics, and if you can see there on the 3rd of January, it is the 3rd, yeah, that you can see that the stochastics also start to move up on that. So by using, I often use stochastics with the harmonic scanner, and would also be looking at moving averages. We'd also be looking at the CO2 for the fundamentals, and so by combining all of these different elements and also checking it against all the other trades, making sure the dollar index is in the right place and everything else, with all of those things in place, we can safely put a trade in those places with a secure stop loss or a mental stop loss. And another thing I haven't spoken about, I know, is stop losses. I do feel quite strongly about the use of stop losses. Personally, I too tend not to use them, just have a emergency stop if I really need it. But I do believe a lot in what we call hedging, which is if the trade turns against you, you go short. at the same time as your long, so you've actually got two trades, one short and one long, and that could cancel out each other until the danger's gone away, and then you can, whichever one's not working out for you, you can get rid of that trade and come out with a profit on that. So, and that's why when you look at some of my trades from the Apari fund, you see that I get 90% winning trades from that, and that's how you do it, by not taking that loss, hedging, and also what we call washing out on your losses. But that's quite advanced, and it's not something to be perhaps learnt at this stage. Okay, so excellent. I'm so happy that you've got to this stage of the video. Obviously, if you're still awake by now, you're doing a great job. You've got patience, you've got your discipline, and hopefully you're a little bit more ready to go. Like I said, trading is not an easy job, but it's worthwhile. It's so enjoyable, as you can see. Hopefully I've shown you some of the passion of what I've got with my trading, how I love to use these tools, and how I do actually love teaching people as well. It's trading can be very, very lonely from day to day. As a final kind of note, really, I think that just as a quick recap, the most important thing for you is to really think about the size of your trade. So you're never worried about a trade when you take a trade. No trade should ever worry you. You shouldn't care if it goes either way. It doesn't really matter, because you've got another 10 trades that are coming up, and each one of those is just in the best position that you can possibly get. And you don't take trades that are obviously not going to work out. You never be silly like that. So good luck to you. So looking at fundamentals first of all, the best thing to do is then to look, I think, at the commitment of traders. Look at your seasonals. Get yourself a seasonals book. The More Research Centre provides those forex seasonals, very, very, very useful, especially with the commodity type currencies such as the Canadian dollar, the Australian, and the New Zealand dollar as well. They're very, very good to use like that. And once you get your currencies, your fundamentals sorted out with, and know what your currencies are doing, next stage, making sure you've got your chart set up properly, making sure you can see everything that's moving. Look at your price actions, look at the long time frames, see what happened a week ago, see what happened a month ago, see what happened 6 months ago, and you'll start to understand where the markets are destined to turn, where they've taken their liquidity. Then check your indicators, check your stochastics, check what the moving averages are doing. All of these things will help you become a better trader. They cannot help but to do that. Now, thank you very, very much for listening, and I hope I've helped you today. If you're looking for some more help, follow me on Twitter. It's JJV Trader, and I'll put that up in a minute so you can do that. My email address can also be jjvtrader@gmail.com, and I'll respond to your emails. There's also a possibility, now I'm not selling this at all, but there's a possibility that there's if you wanted to be one of my mentees, I may be looking at helping a few people out. So again, go to my Twitter account, DM me, and we'll discuss further, and any trading and mentorship that I do with you, I'll be giving you a full personal service for that. None of this giving you lots of videos to follow, and hopefully you can see my style. And if you do relate to this, if this kind of resonates with you, then please do get in touch and follow my challenge. 1% a day, £50 into £1 million, and in a few years time maybe you can be achieving the same with me. So if you've enjoyed this tutorial, please give me a like in the box below, make a comment, tell me what you did like about it, what you didn't like about it. what you didn't like about it. It's always very good. I always want to know those things. And please subscribe to my channel, because maybe in the future we'll be putting some more stuff up. In fact, I'm sure I will do. Good luck and trade well. Thank you. Bye bye.